Good afternoon, everyone. Thank you for joining us in this 2025 first quarter results call of ACS Group. This is Javier Crespo, Head of Investor Relations. The call will be led by our CEO, Juan Santamaría, who is accompanied by our Corporate General Manager, Ángel García Altozano, the Group's Financial Chief Officer, Emilio Grande, and the rest of the management team. As usual, after the presentation from our CEO, we will open up for a Q&A session and look forward to hearing your questions. And now, let me pass it on to Juan.
Thank you so much, Javier, and good afternoon, everyone, and thank you for being with us today. The group has performed strongly in the first 3 months of the year with solid growth in sales, backlog, and net profit, backed by strong cash flow generation. Net profit of 191 million shows an increase of 17% on a comparable basis year-on-year after deducting Q1 2024 extraordinary impacts. Also, please note HOCHTIEF's capital gain related to Flatiron Dragados transaction in Q1 2025 is eliminated at ACS level given it's an intra-group merger. Sales were up by 35%, driven by a strong performance, while operating margins evolved positively across all segments. In terms of cash generation, we have achieved a strong net operating cash flow of 1.7 billion euros in the last 12 months, up 390 million euros year-on-year, driven by sustained high cash conversion. Thanks to the strong cash generation, net debt position at the end of March was 2.8 billion euros, which includes the additional 1.2 billion from the consolidation of this and 623 million of strategic capital allocation in the quarter, such as the acquisition of Dornan or infrastructure investments, mainly data centers, as well as 112 million euros of shareholder remuneration. New orders during the quarter were significantly strong, with 15.6 billion euros. They increased more than 18% year-on-year and represented a 1.3 times book-to-bill ratio. As a result, order backlog increased to a new record level of 90.8 billion euros, equivalent to 2 years of work done. In addition to this strategic acquisition of Dornan, the integration of Flatiron Dragados North America was also successfully completed in January 2025. We're confident we're well positioned to further expand our strong presence in strategic growth markets with significant equity investment opportunities. Looking forward, we remain very optimistic about the future of the group, and we reiterate our ordinary net profit growth target for 2025 of up to 17%. Let's look now in greater detail into the consolidated results for the period. Sales show strong growth of 35.4% to 11.8 billion euros. This solid performance was driven by robust activity across all segments, with continued positive momentum in engineering and construction and a strong growth at Turner, especially in advanced technology, further boosted by the first-time contribution of Dornan. On a like-for-like basis, accounting for this as fully consolidated in Q1 2024, sales growth would still be of an outstanding 23.6% in the period. EBITDA increased by 51.7% to 699 million euros, showing a margin expansion supported by the segment mix. Profit before tax amounted to 354 million euros, up 25.8%, and was particularly fueled by the growth in integrated solutions and E&Z. We delivered a strong net profit growth at 17.2% year-on-year on a comparable basis to 191 million euros, in line with the top end of our growth guidance for ordinary NPAT in the year. On a statutory basis, earnings per share grew by 9.4% to 0.75 euros. The following slide shows the ordinary net profit by segment, and I would underline that, first, Turner's contribution is up 72.2%, reaching the 100 million euros mark, and driven by the strong growth in high-tech markets and biopharma, health, and education. CIMIC is up 4.8% FX adjusted supported by good growth in data centers and other high-tech infrastructure. E&C shows very resilient profitability, as well, growing at 33.7% year-on-year, driven by the North American operations. Abertis had resilient operational performance in the period, but had a lower contribution impacted by non-recurring items such as the new tax regulation in France and the timing of Easter this year. Let's turn now on slide 5 to the cash flow performance. Cash flow generation continues to be strong. Last 12 months net operating cash flow amounted to 1.7 billion euros, 390 million more year-on-year, supported by a sustained cash flow conversion and strong growth from Dornan. Working capital variation was stable, while net operating capex and leases increased mainly due to the consolidation of these. On a quarterly basis, cash flow reflects the characteristic first quarter seasonality and is consistent with the strong revenue growth seen during the period, and also partially explained by thesis consolidation and the decreased factoring. Overall, the group's cash generation remains very strong, and we expect another solid result in 2025. Our net debt position as of March 2025 stood at 2.8 billion euros, showing an increase of 1.2 billion since March 2024, driven again by the consolidation of thesis net debt of 1.2 billion. Our strong last 12 months net operating cash flow of 1.7 billion euros enabled us to carry out net equity investments, an M&A of 905 million, and remunerate shareholders with 712 million. The net equity investments and M&A in the last 12 months included the acquisition of Dornan, the additional 10% stake in TIS, the acquisition of an additional stake in HOCHTIEF, infrastructure investments, which are mostly data centers, and other complementary strategic acquisitions. Moving on to slide 7, our order backlog stands at 90.8 billion euros, an increase of 16.5% year-on-year on the back of a very strong order intake of 15.6 billion euros, up 18.3%, boosted by significant awards in data centers, healthcare, defense, and transportation, and resulting in a Q1 book-to-bill of 1.3 times. I would like to highlight our strong position in Germany to capture the increased infrastructure investment focus. New awards in the country in Q1 have been more than double the average quarterly level in 2024. The trailing last 12 months book-to-bill ratio, a leading indicator of this growth, stands stable at 1.2 times, while the visibility of the portfolio is of circa 2 years. In the following slide, we can see a selection of recent awards. Some key projects to highlight would be: in the energy sector, we have been appointed to design, supply, install, and commission extensions to the existing near above 132 kilovolts and 330 kilovolt substations located approximately 40 kilometers north of Perth, Western Australia. In the data center space, recent additional projects include Vantage 64 megawatts data centers in Melbourne, specifically designed to meet artificial intelligence workload demands. We would also like to highlight the important work we are undertaking in Germany, a key market for the group. Notably, in biopharma and health and social infrastructure, we have been awarded the 190 million euro sold timber expansion of the Rosenheim Technical University Technology Park. The project includes the development of advanced laboratory and machinery facilities, as well as a new student center. In sustainable mobility, we were awarded a major contract for the second main line of the SPAN rail network to link the Ostbahnhof and Marienhof stations in the heart of Munich. In Australia, we were awarded the design and pre-construction contract of the Logan and Gold Coast Faster Rail project in Queensland. Another notable project is the Stubby mine in Canada, where critical minerals such as nickel and copper are extracted in response to the global growth of these essential resources. And finally, we can highlight in defense the Stage 2 construction and upgrade of the maintenance, logistics, and airfield infrastructure of the RAF Base Townsville in Queensland. Let us now have a look at the performance by segments. On slide 10, we begin with Dornan. Dornan has continued to deliver very strong sales growth, increasing by 45.2% to 5.8 billion euros, mainly driven by organic growth in data centers, healthcare, sports, and education sectors. This solid performance was further supported by the first-time contribution of slightly above 300 million from Dornan, showing the benefit of the synergies that are starting to materialize and will continue in the future. Just to serve as reference, note that the ENR 2024 top 400 contractors benchmark grew the revenue by an average of 13.8%. By contrast, even without the additional contribution from Dornan, Dornan grew at 38% this quarter. Profit before tax amounted to 176 million euros, representing an outstanding increase of 62.3%. This was accompanied by continued margin expansion of 32 basis points to 3%, reflecting Turner's successful strategy focused on advanced technology projects. Turner's commercial strength is demonstrated by its new orders of 7.8 billion euros in Q1 25, an increase of 10% year-on-year, driving order backlog to another record high of 33.8 billion euros. This includes a contribution from Dornan of over 1.1 billion. Going forward, we continue to gain visibility on the pipeline to be pursued in Europe by Turner through Dornan of over 20 billion euros. Moving on to our operations in the Asia-Pacific region, we turn to CIMIC. Sales registered strong growth in strategic areas such as data centers, social infrastructure, and energy infrastructure, and were 42% higher due to the full consolidation of this with a stable underlying performance overall. Profit before tax increased strongly by 52.2% to 118 million euros year-on-year, with attributable net profit remaining stable year-on-year. Our order backlog also saw a strong momentum, reaching 23.4 billion euros, up 27.1%, FX adjusted, driven by solid growth across all segments, particularly in data centers, defense, and sustainable mobility, as well as the impact of TCS consolidation. Turning now to engineering and construction segment on slide 12, we can see solid growth, with consolidated sales increasing 17% year-on-year to over 2.5 billion euros, driven by strong contributions from data centers and transportation, particularly in North America. EBITDA margin increased by 53 basis points to 5.28%, reflecting operational efficiencies across both Dragados and HOCHTIEF Europe. Profit before tax grew significantly by 56.6% to 68 million euros, supported by a positive financial performance. And the engineering and construction backlog rose 10.6% to 30.7 billion euros, driven by a substantial increase in new orders, up over 30%, with particular strength in sustainable mobility and transportation infrastructure. Importantly, our book-to-bill ratio remains strong at above 1.2 times. Looking forward, the outlook remains very positive, and I will highlight that we're particularly well positioned to benefit from infrastructure investment focus in Germany, where, as anticipated earlier, our new orders have more than doubled since last quarter. Also, note that Flatiron Dragados is now fully consolidated within Dragados as of January 2025. Please refer to the appendix for detailed financials for Dragados. Continuing now with infrastructure segment on slide 13, Abertis has had a resilient operating performance. The contribution to NPAT was further impacted by changes in the tax regulation of concessions in France. Iridium, meanwhile, increased its sales by 68.4% thanks to the additional contribution of the A13, the A2, Skyports, and assets from North America. On the next slide, we take a more detailed look at the Abertis numbers. The company delivered strong revenues and EBITDA growth on a comparable basis of 7%, underpinned by the geographical diversification of the portfolio and inflation-linked tariffs. Traffic has grown by a solid 1.9%, supported by the strong performance of heavy vehicle traffic. We saw strong results, particularly in Spain, Mexico, and Brazil, and encouraging signs of recovery in France and Chile. Regarding Abertis' portfolio development, As you know, on February 28th, Abertis reached an agreement to acquire a 51.2% stake in the A63 toll road in France. This transaction aligns with our investment strategy to grow our EBITDA backlog and extend the portfolio's concession life while enhancing exposure to stable foreign currency cash flows and ensuring geographical diversification. In Chile, the Santiago Los Vilos concession has begun its operational management transition as of April the 1st, further strengthening our presence in Latin America. Abertis has improved its liquidity and financial strength, with our net debt set at 22.5 billion euros, slightly below the year-end figure, an ample group liquidity of 7.1 billion euros. A shareholder capital injection of 400 million euros will be disbursed in Q2 25 to support growth and strengthen the balance sheet of Abertis as part of the A63 acquisition. Additionally, Abertis distributed 602 million euros of dividends to its shareholders at the end of last week. Let me give you more color on the important investment by Abertis, which we announced at our full year 2024 presentation. Abertis reached an agreement to acquire a 51.2% stake in the French A63 motorway, the strategic corridor between Spain and Northern Europe. The A63 is a 105-kilometer toll road connecting Bordeaux with Saint-Jean-de-Luz, an important tourist area near the Spanish border. It is also a key route between Europe and the Iberian Peninsula for the transportation of goods, serving both as an industrial and touristic route. The acquisition strengthens Abertis' portfolio and financial solidity, with an asset in operation since 2013 and potential for growth during its remaining 26-year life. In 2024, the A63 generated 170 million euros in revenue and an EBITDA of 134 million euros, with a concession expiring in 2051. Thanks to this new acquisition, Abertis reinforces its presence in one of its core markets, contributing to the company's growth and cash flow replacement strategy, extending the group's concession life. This investment, along with the recent acquisitions in Puerto Rico, Spain, and Chile, demonstrate Abertis' ability to grow and maintain a balanced portfolio with a mix of hard currencies such as the dollar and the euro in countries with a stable legal framework. In slide 17, we show the breakdown of key figures by country for Abertis' portfolio. As we close our review of the first quarter results, let me now briefly summarize our solid operating performance. The group has delivered very strong sales of 11.8 billion euros, growing at 35.4% year-on-year. Net profit stood at 191 million euros, up 17.2% on a comparable basis, in line with the upper range of the guidance for the year. And our cash generation remains very strong, with our last 12 months net operating cash flow at 1.7 billion euros, up 390 million year-on-year. Our backlog is a new record high of 90.3 billion euros, growing by 16.5% year-on-year, thanks to very strong new orders of 15.6 billion, a quarterly book-to-bill of 1.3 times. And looking ahead, our capital allocation priorities remain clear. We see significant greenfield infrastructure investment opportunities, particularly in data centers and managed lanes in the US. We remain focused on bolt-on acquisitions to enhance our engineering capabilities in strategic growth markets, as well as M&A opportunities in brownfield core infrastructure through Abertis. Ultimately, our goal is to achieve profitable growth and long-term value creation combined with an attractive shareholder remuneration while maintaining our financial discipline. Let me conclude by saying that we remain confident in our outlook, underpinned by the strength of our business diversification and our global presence, which position us well to navigate and benefit from the current geopolitical and macroeconomic environment, with solid fundamentals and strong growth prospects across our key markets. We are very well placed to continue creating value. Thank you all once again for your attendance today, and I look forward to your questions.
Ladies and gentlemen, the Q&A session starts now. If you wish to ask a question, please press star 5 on your telephone keypad. Thank you. The first question comes from Luis Prieto. Please, sir, go ahead.
Good afternoon, and thanks for taking our questions. I had a couple of questions, or groups of questions. The first one is I would like to get some detail on the amount invested in data center land at the end of Q1, and what the expectation could be for the end of the year. And in this regard, there's been a lot of press regarding the involvement of third parties in your potential projects. I would like to know in what terms, and if you could update us in this sense. And the second question is that we have been seeing a very strong organic top-line performance in Turner, as you described. However, if I look at industry data for construction spend in non-residential settlements in the US, growth is much more contained or even muted. Is there anything we can conclude from this divergence in terms of Turner's market share, competitive positioning? Thank you.
Thank you, Luis. So starting with data centers, right now we have around 500 million euros invested, 200 million last year, and approximately 300 million from the beginning of the year. So the intention is to continue investing throughout the year. Probably we'll add another 300 million to this equation throughout the rest of the year. As we explained last year, our intention was to develop from scratch the land and making sure that we get the permits, connections, etc., so we could get all this land ready to build and obviously sign the leases with the hyperscalers. In parallel, what we're doing is we did open a process to bring a co-investor with us, because we are looking forward to put a very strong platform together with a co-investor. And that process is still ongoing. It's very close to a resolution, so probably we will be updating the market within the next, I would say, from now to the end of the first half. I think that we'll be able to give a solid update with a potential resolution. But until now, all of this is very confidential. But as I said, our idea is to bring a 50% partner to develop what is considered the next stage of our strategy, which is the entire construction and operations post signature with the hyperscaler. On the US growth, I mean, as you saw in general, our backlog has grown 16%. That's year on year. And if you look more focused to the US, Turner has seen a record order intake of around 50% versus Q1 24. And also, I mean, if you just focus on Turner, 95% of our revenues in 25 are secured, and 50% of our 26 revenues are secured as well. I'll move to Flatiron in a minute, but just to continue Turner, pretty much that growth has been seen through all the segments, right? Data centers have more than doubled, but the biopharma healthcare space has also seen, versus the 2024 last year, has seen a huge increase, almost doubling versus the same amount last year, right? We're seeing similar growth in education. We're seeing huge growth in semiconductors. So in general, we are very, 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 very comfortable. When you look at, and your question was more about the engineering and construction, when you look at Flatiron and Dragados, the company is seeing quite strong growth, and we are very comfortable because most of the contracts that were won by Flatiron and Dragados were collaborative. And you are not seeing that in the books. You are not seeing most of that in our order book, because when you win collaborative, you just get engineering and construction. And as you develop those projects, you start getting the contract. But the new awards during the period has come to 2.8 billion, which is significant. Now, what do we expect in the US market and the perspective from Trump administration? I mean, we cannot discuss what's being pretty much published by our companies. But what what we see is that there's a positive outlook for construction, especially in the high-tech sectors, data centers, semiconductors, aerospace, biopharma, that there's a lot of infrastructure programs like the Investment in America, which is pretty much boosting construction in traditional advanced technology manufacturing. There's a 100% tax deduction for industrial fixed asset investments, and there's a AI dominance strategy, which is pretty much promoting the expansion of AI via deregulation. On the other hand, there's a lot of investment in traditional infrastructure, mainly highways, bridges, and airports. And there's also, as we've seen, a political shift in energy and technology. So a lot of the renewables have lost its support, including hydrogen. But there's also a national emergency declaration encouraging private investments in everything else, oil and gas, nuclear, geothermal, microgrid projects, right? So what's the impact that we're seeing and we're going to be seeing in ACS in the next months? First, a positive effect on our traditional projects, highways, bridges, airports, and rail, although rail is more locally funding versus federal funding. A huge investment in managed lanes, huge, and there's huge projects coming in the pipeline, all of those supported by federal funding mechanisms like PAPS, TIFIA, which have not been removed. We're seeing faster project approvals, like the NEPA reforms for environmental processes, and everything that I just said around the high-tech technology. So, I mean, we are seeing, we're remaining very optimistic on the US market.
Thanks a lot.
Ladies and gentlemen, we remind you that if you wish to ask a question, please press star 5 on your telephone pad. Thank you. We have another question, and it comes from Alvaro Lente. Please, sir, go ahead.
Hi, thanks for taking my question. This is Alvaro Lente from Malantra Equities. Just following up on the question on letting a partner into the data center venture, just to understand at what stage are you planning to let them in? Is it before to help you develop up to ready to build, or all the way up to cost of development? Up to COD, and whether you expect to maintain a long-term holding in the projects to have a sort of a brownfield concessions there. And then the second question, if you could provide us some guidance on working capital for the rest of the year. The swing has been a little bit higher than we were expecting. So I don't know if you expect a significant reversal of that to, of course, nothing like we saw last year, but maybe a softer number for the year end. Thank you.
Thank you, Alvaro. Starting with data centers, we are currently developing in our portfolio 2.1 gigawatts. We are looking for land plots of additional 5 gigawatts, right? But so far we have in our books committed or invested up to 2.1 gigawatts. Some of that we're about to sign an LOI, a letter of intent, or a lease agreement. Some of that already has an LOI with us. Some of that is ready to build. Some of that is in the process to be developed. So we have 2.1 gigawatts in different stages, right? The idea would be sometime mid-2025 to bring a partner that is going to value our current portfolio, and it's going to, the intention is to monetize 50% of the portfolio, right? We would stay 50%, we would monetize 50%. Moving on, that partner we will put together a platform, and it will be the platform, the one that will be developing not just moving the current 2.1 gigawatts into the next stage, which is basically construction operations, but also developing the future land. That's intention. I mean, you will be hearing news in the first few months. On cash flow, I mean, the first thing that I would say is what we introduced in the presentation. In the last 12 months, the net operating cash flow was around 400 million better than the same period before. And this was mainly because of 770 million better EBITDA, right? And that was both Turner, E&C, and disconsolidation. The working capital was stable, and then there was an increased capex and lease that was against us of around 370 million. If you compare Q1 net operating cash flow versus Q1 next year, it's better by 118 million year on year if you adjust by the disconsolidation and removing the factoring, right? So comparable terms, 118 million year on year. So we are better than what we were Q1 last year, which we had a stronger reversal. And then when you look at the working capital in Q1, this is explained by a worsened working capital of 70 million in this, factoring that we reduced by 168 million, and the rest is very consistent with revenue growth, right? So that's analyzing the last 12 months in Q1. What should we expect from the rest of the year? I mean, we are comfortable. We believe that we're going to have a strong cash flow as we had in 2024. So, I mean, I wouldn't, at this stage, I wouldn't call it softer or worse. I mean, I think we are in line to a positive 2025 cash flow.
Thank you.
We remind you that if you wish to ask a question, please press star 5 on your telephone keypad. Thank you. Well, it seems that there are no further questions, so I will give back the floor to the management of ACS to close the meeting.
Okay, so thank you so much, everyone, for your time today. And of course, we are available for any question you want to follow up. Thanks again.